Capita shares plunged as much as 16% on Tuesday after a Cabinet Office minister stood in the House of Commons and condemned the outsourcers' handling of the civil service pension scheme as a corporate failure. The stock had already fallen 10% to 290 pence the prior session and extended losses to 236 pence as the scale of the operational breakdown became clear. The scheme covers 1.7 million civil servants, and at its worst, the backlog reached 120,000 unresolved cases, including 4,100 families waiting on bereavement payments. That scale of failure sits against a specific promise. Capita's chief executive had personally assured the minister that technological improvements would create, quote, the largest AI-enabled pension scheme in the country. The non-delivery of that technology, the minister told MPs, was a fundamental part of Capita's inability to deliver. The government has already withheld £9.9 million in payments and deployed he would. The question the stock cannot yet answer is whether Tuesday's fall reflects only the announced penalties or the genuine risk of contract termination.
Capita's own trading update, published the same week, quantified the direct financial damage. Adjusted operating profit reduced by £25 million to £40 million. Free cash flow cut by £35 million to £50 million. And the return to positive free cash flow pushed back to 2027. Those are the numbers the market priced into the 15% decline on Thursday, and they look severe on a company already trading below 250 pence. The deeper problem, however, is that the numbers understate the operational reality. Staff on the contract reported to their union, PCS, that they were uploading large volumes of data into live systems despite known validation failures, line-by-line manual checking substituting for the technology that was never built. The union said this created unnecessary risks of error in the pension records of serving civil servants. When the data integrity of 1.7 million people's retirement accounts is in question, the risk is no longer just a profit shortfall. It becomes a regulatory and legal liability the trading update does not capture. Capita's public response said the company now has the processes, automation, and technology in place to work through the backlog. The minister's evidence to the House of Commons told a different story. The backlog skyrocketed to a staggering 120,000 unresolved cases. The April deadline was missed, and the June deadline was missed. Those two statements cannot both be true, and the parliamentary hearing on Wednesday will force one of them into the record. The buried assumption in the consensus view that Capita is managing a difficult transition and that penalties will eventually resolve the situation rests on one premise, that the government will stop short of full termination. That premise is now directly challenged. Capita had 2 full years of transition between contract award in November 2023 and the December handover, and in April, Labour terminated Capita's Royal Mail pension contract after a pattern of failures almost identical to what is now visible in the civil service scheme. The minister did not say the Royal Mail outcome was extreme. He said insourcing the civil service scheme was something he would do if I could.
The transmission from penalty to termination has a specific timeline. The government's October update is the declared checkpoint for the insourcing decision, but 2 earlier events sharpen the picture sooner. The Joint Parliamentary Committee hearing on 8 July puts the minister and Capita's chief executive in the same room, under oath, with the Royal Mail precedent on the table. And Capita's own trading update, promised later this week, will either confirm or extend the profit warning already in the market. The $239 million contract is not a peripheral revenue line. It represents a substantial portion of Capita's government services income, and the 2027 free cash flow recovery that analysts are now modeling depends on the contract remaining in force long enough for the remediation costs to be absorbed. If the contract is terminated before that, the path to positive FCF disappears with it, and the current share price, even at 236 pence, is not discounting a no-contract scenario. Against the genuine counter case, Capita argues it now has the technology in place, and the minister acknowledged that immediate termination risks a catastrophic operational vacuum for 1.7 million members. That operational dependency is real. It is not a clean exit even for a government that wants one. The risk is therefore asymmetric rather than one-sided. The contract may survive in weakened form, with mounting penalties, rather than terminate cleanly. For a holder, the question before October is whether the trading update this week shows any evidence that the backlog is actually clearing at a rate the government can accept. For a watcher, the October insourcing decision is the binary. If the government stops short of termination, the 236 pence level may price the worst case. If it follows the Royal Mail template, no level below today's price is yet a